Welcome, ladies and gentlemen, for a special edition on the Fund Awards, organized by the newspapers De Tijd and L'Echo. This year, 19 awards are presented to the best investment funds and fund houses on the Belgian market. This is based on performance and risk during the past 5 years. The main award for Best Fund House over all investment categories goes this year to the French company Carmignac. We have the honor to have his chairman here with us, Mr. Edouard Carmignac. Welcome, Mr. Carmignac, and congratulations. We all know the flagship fund Carmignac Patrimoine, but the best performances we saw the last 5 years were actually in the equity funds, Europe, emerging markets. Now, how do you look at these equity markets today? Some investors say, well, there is a bubble that might burst soon. Do you agree with that?
Well, I think that first of all, we have to acknowledge that these concerns are legitimate. We've been through a paradigm in which we've had massive fiscal support plus monetary support. Now, as we all know, the US is wanting to increase meaningfully fiscal support through the Biden administration, so that the overall cocktail of support is leaning towards more fiscal while maintaining the monetary one. And naturally, there's no magic. At one point of time, the financial markets, particularly the bond markets, are right to ask the question: well, can we keep on financing such an expanded fiscal support while at the same time not increasing commensurately the monetary one? And so that we've been witnessing, particularly since the Georgia election, which, as you all remember, has given really freedom for the Democrats to spend. We've seen interest rates increase meaningfully in the United States, and thereby, by pure contagion, impacting also European fixed income markets, and to a lesser extent, markets in the emerging market world. So that as we come out of this pandemic, as we all expect, we hope we will come out in this spring, particularly surely in the States, because as we know, the vaccination campaign is really far more advanced than it is on our shores. We should have strong growth and supported by additional fiscal spending, and by the fact that during this period, individuals have been saving substantially, so that their disposable income there is meaningful. So the markets are right to question themselves: aren't we going to have an unsustainable demand here, which will push inflation pressures? We believe that provided the fiscal spending in the US remains reasonable, which remains to be seen, because Democrats have taken some pretty strong commitments there, those inflationary pressures should not be lasting ones. But as far as equity markets are concerned, what is important for them is not only nominal rates, but also, more importantly, real rates. That is, nominal rates minus inflation. And if inflation picks up, and this inflation pickup is not a lasting one, then we should keep on having reasonably good stock markets. Now, will they be rising meaningfully higher from where we are here? It remains to be seen, because sure, we will see great earnings, but rates which will be higher. So the valuation of these earnings might not be as generous as it has been in the past.
Okay, so rather positive on the equity markets. If we now look at the bond markets where we have low yields, negative yields, do you see there opportunities? Is there value to get in the bond markets?
Now, obviously, with this setup which I've been describing, the outlook for bond markets is far more challenging. Do we see still pockets of value in the bond markets? Very selectively and those are two main pockets in which we find value right now. It's on the credit markets right now, and being very selective there again. Choosing companies which will benefit from this reopening. So you can think companies in travel, leisure, in general, which have been suffering greatly. That is on the Western world. So you can see pretty sort of a narrow scope of companies that are still offering good yields and which have improving economic prospects. And in the emerging market world, we see mainly value in China right now. The 10-year bond rates in China are over 3%, about 3.25%, while inflation is close to zero. So so real rates of about 3%. Whereas as we know, the real rates in the US, for instance, are negative minus 70 basis points. On top of that, China, as we know, has very sizable currency surpluses, trade surpluses rather, which support the currency. So there is value there.
Okay, then maybe a final question on gold. Gold has always been a good insurance for investors in bad times. Do you think gold today should be a part of a portfolio of an investor?
I mean, we have reduced very meaningfully our gold holdings over the past few months. At one point of time, we had about 8% weighting on gold. Right now, we're under 2%. In this environment of rising rates, and I insist on rising real rates after inflation, gold it will not be the darling of the markets, obviously, but I'm still supportive of keeping some gold in the portfolio, even at a reduced level, because I feel that this very large fiscal spending is undoubtedly concerning, and that have an asset that will protect us against some runaway inflation risk or runaway fiscal spending is not a bad thing. But for the time being, I'd say in the short term, these rising rates are an impediment to a gold appreciation, I must say.
Okay, thank you very much, Mr. Carmignac, for your interesting insights. And ladies and gentlemen, if you want to discover more on the Fund Awards, please discover the dossier on our website, The Tijd and L'Echo. Thanks for being with us, and hope to see you soon.